So again, welcome. We appreciate everybody taking time today. We hope you find this very informative. Let me tell everybody who's going to be talking today. My name's Jim Atkins. I'm managing partner of Artisan Advisors. My co-presenters are Jeff Voss, who's also a managing partner of Artisan Advisors, and John Hecht, who is a managing director and runs our Wisconsin office. We're going to be leading you through a lively discussion today, and we hope you'll find it very interesting. Today's agenda is going to be fast-moving, fast-paced. We have a lot of things to cover, and we promised to only take about an hour of your time. So what we're going to do is I'm going to start out with some opening comments on Survive or Thrive. We're going to then go to Jeff, who will kick things off with a quick but fairly deep dive into the economy as it stands today, what the numbers look like, how we got here, and what it means to bankers today and over the coming months. Then we're going to jump into the state of the banking industry, where John will take us through a review of the state of the banking industry and highlight key issues and considerations that will affect executive decision-making in important ways. Then next, after that, we're going to have a little roundtable and talk about the outlook for the banking industry and give some of our opinions on trends and things that are happening. Then we'll have a quick discussion on strategic considerations. We'll then have a tale of two banks and give you some examples of some banks that got it. Then we'll have some closing thoughts, and then we'll have questions. At the bottom of your screen, you can type in questions. We'll handle the questions at the end. If we don't get to your question, we promise you we will email you back an answer to your question as quickly as we can. So with that, let's move to our first slide. And let's see. First of all, Survive or Thrive. Didn't we just go through this? To me, it seems like it. You know, I'm a veteran of the Great Recession, as many of us are. And it just seems like we just went through this. And some of the names and some of the things from the past, we had, if you remember, we had 527 bank failures. We had Bear Stearns. We had TARP, the GM bankruptcy. And of course, something that we all love, dear to our hearts, Dodd-Frank. And of course, who could forget consent orders? It was quite a time. How some of the questions that come as we've gone through that period, as we look back, some of the questions, or at least two questions, come to mind. Some banks made it through the Great Recession and some did not. And then why was that? And also, why did some banks not only survive, but actually thrive during that period? You know, we believe that banks are currently faced with complicated decisions about whether they're going to survive, thrive, or both, given ever-shifting circumstances. We've created this four-part webinar series to help bankers address those decisions on multiple levels, including strategic planning, financial, operational, and regulatory considerations, and the post-election world and what that might have in store for our industry. Today, we're going to focus on setting the economic stage. This is really the kind of the building block for our four-part series, and we're going to explore present economic and industry conditions, look into our crystal ball for some trends to consider, and we're going to talk about how strategy fits into all of this. So with that, I'm going to turn it over to Jeff Voss, who's going to give us a discussion on the state of the economy.
Thanks, Jim. There's no question that the impact of this global pandemic has resulted in a rapid and severe downturn in our economy. It's becoming quite clear, too, that a return to the pre-pandemic economy hinges on the successful and accessible treatment to the virus. What we originally thought was a short-term 3 to 6 month problem now seems to be more like a 1 to 3 year challenge. Our early attempt at reopening the economy, combined with social unrest in our major metro areas, has resulted in an intensification of the pandemic and widespread economic concerns. Many sectors of the economy, like restaurants, airlines, entertainment, will remain disrupted until this virus is over. Those parts of the economy that have reopened are functioning at the mercy of public health policy, some with disrupted supply chains, and more importantly, the consumer's willingness to leave their homes. So let's dive into the data. The U.S. economic activity declined in the second quarter 9.5% over the previous quarter. This equates to an annualized rate of 32.9%. While this metric is shocking to most to hear it was expected by most economists and the markets. In the midst of a global pandemic, most other developed markets have reported losses of similar magnitude. The American economy is functioning at about 90% of its peak, so the challenge is recovering that last 10% of lost output, which is going to be slow going. As everyone knows, the fix for COVID-19 remains incomplete. Most of the regions of the U.S. that experienced outbreaks earlier in 2020 have avoided a resurgence, but the virus continues to spread, particularly in areas where reopening had happened quickly and without appropriate cautions. The significant growth in new cases noted in Texas, California, and Florida appear to have peaked, but without effective treatment, a sustainable recovery will require vigilance of businesses, consumers, and our government. As a result, nearly all states have imposed some business restrictions, typically focused on bars, restaurants, nightclubs, concert venues. Some states have even imposed travel restrictions, limiting the physical mobility of both businesses and consumers. In April, the nation's unemployment rose sharply to a peak of nearly 15%, but that since has declined to 10% in July due to the limited reopening of the economy. Past cycle peaks were 10.8% in 1982 and 10% in 2009. While the recent July reading is still high, at least it returned to prior recession levels. Unfortunately, the recovery will continue at a slower rate from here, absent the virus fix. The boost from reopening is past, and jobs lost in the most severely affected sectors will take the longest to return. After acting decisively to support the economy in March, Congress is at a stalemate on the subsequent round of COVID-related stimulus. Key consumer supports like the $600 supplement to unemployment insurance and the moratorium on evictions were allowed to expire in July. Presidential executive orders recently signed are not likely to be very effective without a comprehensive legislative response. Another metric tandem to the consumer confidence is the consumer savings rate. Since the crisis took hold, the savings rate has been elevated significantly. Savings constituted 19% of disposable income in June, after peaking at 33.5% in April. The savings rate hovered around 7% before the pandemic hit. Consistently elevated savings rates suggest that consumers are bracing for the stressful conditions ahead and not spending. What about inflation? Large-scale fiscal spending and monetary intervention stoked fears of inflation, but it has not yet materialized. Indicators like CPI reflected modest increases in medical and food prices due to elevated demand and scarcity concerns, while transportation and energy prices fell due to falling demand resulting from higher unemployment, lower domestic output, and the impact of the growing remote workforce. So what are the negatives again? GDP falls 32.9% in the second quarter. Unemployment rises to 15%. Consumer confidence falls due to higher unemployment and uncertainty about the resolution of COVID, as does their spending. Consumer prices fall in energy and transportation, reflecting broad-based slowdowns, and rise in food and medical, reflecting demand changes as a result of COVID. The second quarter results in the economic metrics that broke records for speed and severity of their declines, but hopefully this is all in the past. That said, more recent economic metrics reflect possible upward movements in the economy and a sense of optimism and resilience. Even a limited return to normal activity will bring high growth readings in the near term. Quarter-over-quarter growth is poised to show significant improvement from a depressed base. Slow recovery is still a recovery. However, a full recovery is going to take some time. So what's the FOMC done to support the economy? Well, first, they've lowered the benchmark interest rates to near zero, which was done swiftly in anticipation of the impact of this downturn. As a result of that, mortgage rates have also declined, caused by the Fed's active support in buying mortgage-backed and other types of treasury investments. Consumer mortgage refinancing has continued at extraordinarily high levels. Limited housing supply has also resulted in an increase in the real estate market values, allowing refinancing to continue. Additionally, the Fed's forbearance initiative being used by banks has at least prevented a repeat wave of foreclosures that as seen in the 2008 and 2009 global crisis. The ultimate success of business and consumer loan modifications will be dependent again on the ability of businesses to fully reopen and the consumer to return to normal employment activity, both having the ability to make its monthly payments. So what about the stock market? The stock markets, the S&P and Dow, both fell over 34% in less than a month from the middle of February to early into March. Just as quick, the stock market saw the fastest 20-day rise in the entire 100-year history of trading. As a result, investors today have not seen their retirement savings free fall in value. In some cases, they've actually risen. Many question how the stock market can continue to rise while the country and the whole world are still dealing with the global recession. There are several factors helping the seemingly inflated market valuations. The Fed continues to pump money into the economy as they've shown, and that they're willing to do whatever it takes to keep some sense of balance and order in this world. The Fed has also promised to keep interest rates low for as long as it takes, and as long as the pandemic data justifies it necessary to do so. And this should help markets like durables and consumer housing. As a society, we're saving lives by our actions of closing down, limiting businesses, activities, and social distancing. Pharma firms continue to work diligently to get a vaccine into mass production, yet it's highly unlikely that they're going to be ready before year end, leaving the stock market with a valuation bubble. There comes a point, though, too, where the stock market and small businesses can no longer shrug off the impact of the COVID-related responses. So don't be surprised if another market correction occurs if we don't find a solution to COVID soon. At the latest meeting of the FOMC, they modified their statement about their policy position, stating the path of the economy will depend significantly on the course of the virus. This statement is significant as an indicator of how the Fed will gauge economic progress. The Fed has extended its temporary crisis response programs, such as its liquidity facilities for money market funds and short-term commercial paper through year end. The Fed's recent forecast of policy indicates at least that they think that the GDP in 2022 will be back at a 2 to 6% range. You'll see that the unemployment range that they show is 4 to 6% in 2022, and the inflation should range somewhere between 1.4 and 2.2%. So the positives are interest rates fall to historic lows, allowing homeowners to refinance their mortgages again and businesses to lower their monthly payments. But for those with bank deposits, savings rates have also declined. Stock markets continue to remain optimistic for a solution of COVID and anticipate that the economy will get back on track. And the Fed continues to provide a forecast which provides businesses with assurance as to the direction of their policy-making guidelines for interest rates. Summary, the economy will rebound from its current economic situation, but the recovery is going to take certainly all of 2021 and probably most of 2022. And it's totally dependent upon the outcome of two events now, the outcome of the pandemic and possibly the outcome of the presidential election, which we'll talk about as we go later into this webinar. Interest rates will likely again remain in a low range for as long as it takes, and I think the policymakers will definitely be slow to move up in order so that they don't jeopardize the recent positive activity in the economy.
Thanks, Jeff, for that look into the economy. And now, John Hecht. John, will you take us through the state of the banking industry?
Sure. Thanks, Jim. I'd like to walk through several series of slides here just to kind of give some big picture trends, what's been happening over the last several years and quarters in particular. This information comes from the FDIC, and they aggregated all the bank call report data. Unfortunately, that has not been officially updated through the second quarter, but I think some of the trends that we're seeing here were likely to continue. First of all, I think when you look at this first chart, the banks that had earnings gains year over year to the previous year's quarter, you can see that number has been steadily falling here since really the beginning of 2018, where we had the tax cut. And I think in this latest quarter here, only 44% of banks are showing annual earnings gains. A lot of the reasons for that are increased provision expense. Also, there were some fairly significant goodwill impairment charges booked at some of the larger banks. But I think we're also seeing the cumulative effect of reinvestment at the very low interest rate environment that we find ourselves in. Our quarterly return on assets, or ROA, there's kind of an unusual spike there in the fourth quarter of 2017 when the new tax cuts were enacted and signed into law. A lot of deferred tax assets were remeasured, causing some write-off of tax benefit. And then at the beginning of 2018, as those tax rates were effective, you could see there was a nice bump up. And then in the last year and a half now, we're starting to see an erosion. As the primary driver of bank earnings, our net interest income fell for the second consecutive quarter on a year-over-year basis, and they continue to march downward. Larger provision for loan losses and also increase in kind of annual operating expenses are also weighing down bank return. Now at the end of the first quarter at 38 basis points. That's down almost a full 1% from the same quarter a year ago. So definitely a concerning slide. Net interest margins are continuing to compress as your decline in asset yield is outpacing the drop and how quickly banks can respond to reduce funding costs. The flattening of the curve really out through the 10-year mark, combined with a lot of rapid prepayment of any mortgage-related assets and limited opportunities for reinvestment is taking a toll. We're likely to see potential margin dilution now when second quarter results come in, primarily due to the rapid acceleration of PPP lending, and really depending on how much of the SBA origination fee banks recognize. Although what I've heard many bankers also taking corresponding loan loss provisions to offset some of that one-time fee income for origination on the PPP program. Yield on earning assets, as I mentioned, they're down sharply in the first quarter with market rates leading downward. Mortgage rate, in particular, we're approaching historic 50-year lows, which we hit during the second early part of this quarter, and as a result, triggered really a tsunami of refinancing activity across the industry. Those prepayments are really impacting book yields, especially if buying bonds at a premium, having to write off some of that premium faster than expected. And then just purely the investment opportunities, yield opportunities are very limited. So we're seeing that erosion on asset yields. Likewise, the quarterly cost of funding earning assets declined, but just not as rapidly as market rates on the asset side have come down. Also, there's I call it the ground effect. when you start getting close to the 0% rate, you just don't have the opportunity, and that's when compression really takes a toll on the margin. That's what we're seeing currently, and also the value of non-interest bearing deposits really doesn't help at all. But this is, I think, a time when banks, if you're not meeting on a monthly basis, talking in your ALCO or pricing committees, I would really strongly encourage everybody to take a look at this. And I think if you'll see the dichotomy here between the large banks and I guess I'd call the community bank market, larger banks are really aggressively rolling rates down in light of some of the huge deposit surge that we've seen, and really with no good opportunities to invest. I think this is a time you really need to test the interest rate sensitivity with some of those surge deposits, because again, it's hard to deploy those in any type of a margin. Let's take a look now at some of the income and expense non-interest. You can see that operating expenses as a percent of revenues bumped up, and across the board we're up at 3 out of every 4 banks nationwide. Even though the first quarter was skewed a little bit by some large goodwill impairment charges at some of the larger banks, just across the industry, even salary and employee benefits, averaged about a 2.5% increase. And non-interest revenues were pretty stable under the circumstances, led by some good mortgage activity and also merchant credit card, as more of us are ordering things online with cashless type transactions. Provisions, on the other hand, spiked up rapidly, up almost 280% compared to a year ago. A lot of the larger banks are starting to adopt CECL, the current expected credit loss. But you'll notice here almost half of all banks reported year-over-year increases just in their provision. And we'll almost certainly see that rise in the second quarter and possibly future periods, especially if government liquidity relief support are being pulled out of the market. So that will be one to really keep an eye on. Efficiency ratios, marked difference, large versus community banks, 10 percentage point difference between the two. And the decline, which is a good trend in efficiency at the large banks, shows that they've been a lot quicker to adjust operating costs in times when credit or net interest revenues fall. In the management of a lot of these publicly traded larger banks, they're under a lot more pressure to respond from shareholders, investors in times like this to maintain their earnings. Whereas community bankers are going to be a little more measured in their response, although it's really hard to ignore the current stress on earnings and capital that the crisis is and will create. So I think it'll be important here to really take a look at the rationalization of expenses when really the levers of other opportunities bankers have to manage earnings are really not available. It does force a strong look at things like your branch operation versus, say, fully digital online mobile banking channels and platforms that are going to rise in importance the longer that this economy suffers. Capital ratios, they're beginning to show signs of deterioration as both the earnings coupled with asset growth, which is kind of a double whammy here, are eroding that critical second layer of support. Compared to the ratios prior to the Great Recession, this chart doesn't show it, but when I look back, it's clear to me that banks are in a better position to weather a downturn. And higher loan loss provisions will certainly stress capital levels as well as the asset growth created by a lot of this deposit surge for those people seeking liquidity and safety have started to really balloon bank balance sheets. So, and we're going to see that in the slides ahead. In the second quarter, we're also going to see the impact of PPP loan funding, and that'll absorb some of the excess surge deposit liquidity. However, let's not forget those assets really only earn 1% after the fees are recognized, and that'll create earnings challenges the longer that those loans stay on the books. Forgiveness of those PPP loans are going to be key to begin reducing the lower yield loans. And the SBA just recently opened up their forgiveness platform, I believe, in the last week now. So that's something to take a look at. Loan growth over a year over year has been strong at 8%. And leading the way was a C&I increase at 15%, which is the leader of the group here. It's really noteworthy that there was a reduction in unfunded loan commitments that represented the largest quarterly decrease in the 10 years that data was available. So essentially, even though a lot of that was concentrated in large banks, I'm guessing a lot of the bankers on the call have seen a lot of their customers draw their lines, not only to kind of test the line, but also just to sit with more liquidity on the books, just in case. It's always better to have cash available. Sometimes credit is not always accessible for various reasons, and so I think a lot of organizations and companies took advantage of their lines of credit, borrowed as an abundance of caution. We're certainly seeing that in these numbers. But also, in the last 12 months, up until the pandemic, the economy was very strong, and I think you were seeing good consumer and business confidence and investment. Obviously, now that pandemic has hit, that's really changing the equation here. We're seeing much weaker growth, an erosion of consumer confidence, as Jeff's slides show, and the consumer is actually deleveraging right now in light of job loss uncertainty, especially with future unemployment benefits and support. So I think we're going to see the consumer really backing off, and that'll have ripple implications on all the other credit products. 12-month deposit growth, we have seen deposits surge by 1.2 trillion in the industry from the fourth quarter of 2019. So in 3 months, we've had an incredible influx of money into the banking system, some of it obviously from government relief and other sources, but the largest growth is clearly on the transaction deposits, the more liquid, accessible sources, as evidenced by a sharp decline also in time deposits. And that type of customer behavior is pretty typical in periods of uncertainty, as we experienced kind of most recently in the Great Recession, although not as rapidly as the pandemic health crisis has induced. And I think here you're going to see access to liquid funds and the safety of the FDIC insurance will continue to dominate customers' minds and preferences. And then this chart here, obviously non-current loan and quarterly charge-off rates showing great progression, great progress since the last big recession here. And in my opinion, kind of reflects the calm before the storm, with a significant level of loan mods and deferrals, which I think have really masked the potential deterioration that we're seeing in credit. And favorable accounting for some of the short-term restructuring due to COVID also helped to restrain any non-performing loan ratio growth. But I think as we move into the second quarter and beyond, there will be significant impact the longer we go without that effective vaccine and remain in a limited capacity environment for business. In summary, the banking industry really is facing up to a formidable number of challenges for the remainder of this year and next. The low interest rate environment, you've heard Jeff, there's really no relief in sight for higher rates, and that will have a negative effect on reinvestment yield and opportunity. Your economic activity deterioration will have an impact on asset quality, which is the biggest risk bankers always face. Operating expense rationalization is going to be, I think, almost a mandatory exercise as we look at the levers of profitability and growing earnings and capital. I think everybody's always going to have to take a look, but probably even sharpen the pencil hard. And then any IT-related investment, if some of that involves digital platforms. Who knows how long we're going to have this deposit surge for liquidity. Let's all hope that it's a shorter term phenomenon, but we do have to recognize that that is not a permanent liquid infusion into the bank. And then finally, we've had a very accommodating regulatory response thus far. And I think that's a good thing, since this is a crisis that really was brought on by something really outside of everyone's control. But as this deepens and lengthens, I think we really don't know how the regulatory agencies will respond. Not to mention the fact that we have a potentially new administration coming, and the Consumer Financial Protection Bureau and other agencies may be changing some philosophy and policy. So we need to stay really tuned for changes there. I think in the current time, regulatory support has been very, very good for the banking industry. So those are kind of some of the key things and challenges here that bankers are going to have to deal with.
Thanks, John. Let's go into a little roundtable portion here and go back and forth with the Artisan Group. First of all, Jeff and John. Jeff first. How might the political situation, in your opinion, affect our industry as we go forward?
Well, any level of uncertainty, whether it's political or economic, is going to have a potentially negative impact on the banking industry itself. I think the political side, if there is a change in administrations, I guess our logic would say that you could assume that there's going to be higher taxation, most likely in businesses. So what was given back to us a few years ago now, is potentially could be going back the other way again. In theory, we have to pay for this stimulus in some way, shape, or form. And I think the other administration is probably more likely to tax businesses in order to get that back.
John, what's your thoughts?
I'd agree a lot with what Jeff said, that higher taxation is likely, almost, I won't say a certainty, but I think, we do have to figure out a way to fund the stimulus, the relief. Corporations and banks seem to be a target that's often singled out. But I think in general, any uncertainty in an economic environment, investors will sit on their hands, they'll sit on their cash. With the election coming up here, and we're a divided country, so it's really, really difficult to handicap this regardless of what polls say right now. I think between the uncertainty of the vaccine with the potentially new administration, and as Jeff said, the political situation, everything is politicized these days. There is so much hanging in the balance right now that it is really hard to say what direction we're going. So I do think we're going to be everybody's going to be looking for signals, and I think it's just going to be a little while before we really have any firm answers. Maybe another 3 to 6 months before we really can get a clear picture of who the winners and losers are going to be, and how investors are going to respond at the end of the day.
You two guys are CFOs, came through the CFO ranks back in the day. Let's talk some risk management. Jeff, why don't you discuss a little bit for everyone concentration risk and what you're seeing in that topic, and also by extension loan quality and the importance going forward for our executive bankers listening in.
Well, everybody, I think, remembers back to the last recession and the tales of high concentrations in certain markets. So every bank should be focused on concentrations of risk, whether it's borrower or industry type. And clearly, in today's situation with COVID, there are industries that have been severely impacted by COVID, and then some maybe not so apparent. I think a deeper dive into the red flags, the mods that the banks have handed out, and a deeper dive even into the clients that took out PPP, from a loan by loan credit quality scenario. Banks should be looking at those carefully to see if there's problems with those clients in the future performance.
Jeff, I think you might remember we just finished a project not too long ago where we helped the bank risk rate their NAICS codes. And,
right.
I thought that was a real interesting process, and I think it gave the client bank a really good idea of, what their portfolio, how it really stacked up in light of everything that's going on. So that's kind of an effective thing. John, you do a lot of work helping banks with operational efficiency. It's something that's close to your heart. Why don't you take a few minutes and talk to our bankers about that issue, especially regarding operating costs and in particular, maybe technology?
Yeah, thanks, Jim. One of the things that I continue to see is just the innovation in the industry that is improving productivity, and more technology is coming to the market. A lot of the core providers are not only rolling out integrated applications that really speak to each other, but I think you're seeing the fintech influences also in the innovation there, as a lot of the core providers are actually buying some of this technology and incorporating it. Some of the areas that I see that the technology is really going to touch are let's talk about the branch network and the operational support for lending and deposit administration. More and more of that is moving to digital platforms and self-serve models as they come to market. I've seen a couple of banks that have been deploying intelligent teller machines, or ITMs, and teller cash recyclers that really reduce the overall branch staffing effort without sacrificing internal controls, and allow for more of a consistent customer experience and a very savvy customer support group. I also see great promise in small business lending portals that are available 24/7 to entrepreneurs, small business, which has been really one area that community banks and others have really kind of had the lion's share of that market. But I think as more and more competitors are coming in, banks need to be looking at these digital platforms where they can improve the ability to apply, to underwrite, to approve, and then close those, much of which done on kind of using a self-service, uploading tax returns, artificial intelligence to screen and do some of the underwriting, albeit not all of it. But that's where fintechs have led. And if banks aren't exploring it or looking into it, I'd be willing to bet that you're seeing the volume in your bank's small business lending starting to erode, as that really becomes more of a mainstream type offering. Look at Cabbage and other On Deck and other PayPal. They're all crowding into the bank market because they make it so convenient and so easy to use. And that's an area where I think banks really should be looking into that technology, how they can use that not only to enhance their existing base and reduce the administration, but even to expand their market. I've seen it very successfully deployed, and some of the tools now are really good. So bottom line, I think competition is going to sharpen performance, and it will demand that we do more with less in a relentless quest to be the best while improving the customer experience. That's easy to say, but I think that's where the industry needs to go. And I think those are areas that these digital online platforms and mobile banking tools are becoming much more sophisticated day by day.
I think you're right, John. Even something clients, something as small as DocuSign made a big difference in this pandemic, as people were trying to do business over the internet and over through secure portals and things like that. So even the little bit of technology can sometimes make a big difference. Jeff, my 82-year-old mom and dad are not too happy about the CD rates, that's for sure. But I guess the banks aren't too happy about the loan rates either. So give us some insight on ALM, during the COVID and post-COVID.
Well, I think the FOMC has set out the baseline for rates and where they're going to be at for a while. I would tell your 82-year-old parents that not to expect banks to pay up for their deposits, and they're probably going to continue to be unhappy with the yields that they're getting. I would say this: banks have created policies, ALM policies, to protect themselves in times like this, to protect themselves by collaring bands of interest rate risk. And while it seems sometimes opportunistic to go out and do things in a big way, borrow money long term in a big way today, using with low rates. Assess that risk appropriately within your policy and your interest rate risk models, because ultimately we can't forecast the future for interest rates that accurately. The policies are meant to protect you and to protect your shareholders. I think the liquidity side of the game, we'll have plenty of liquidity in the system for the short term, I believe. The question that John raises in the surge of deposits, will those funds need to be used? Again, without, I'm sure part of that surge had to do with businesses drawing down their lines, as he indicated, funds coming in from stimulus. But if those lines of credit need to be used to either support the existing debt that they have on their books, or to pay employees to keep employment, keep their employees employed, I think that liquidity number that's on your books today could go away, but time will tell. Time will tell.
Thanks. I think that's exactly right. I'll take this last one, the regulatory response post-COVID. I think the regulators have been very accommodating since the pandemic hit, and rightfully so. We at Artisan Advisors think the regulators made the right policy call, and enacting the modification policy. I think it was the right thing to do. It appears that, to me, and to I think Jeff and John as well, that where do we go from here is still to be determined. The regulators are collecting data on modifications. I believe, if I'm correct, Jeff, this is the first call report that modification data was reported.
Yeah, that's correct. Yep.
And I don't think it was reported in its entirety, but there were bits and pieces that came through. So I would suspect that the regulators are not going to make any major shifts in regard to the modification policy until they have a chance to digest and analyze and scrutinize and all those words about the data, looking at the data. So I think one concern in talking through people in the industry and the regulator friends and things like that, the concern is, of course, as everyone would guess, fake profits, right? Where loans are on the books. These companies are not coming back, but yet they're still under modification, and basically we're pumping up bank profits, and it's a risk that I think the regulators have foremost on their mind, and it's something that Jeff and everyone at Artisan, we've been talking about quite a bit. I drive around like everybody, and I look at a store, and I can tell a store that's just shut down, and then I can tell a store that looks like they're never coming back. It definitely has a different look. So those determinations are going to have to be, weighed and analyzed. John, any follow up on that comment?
I think that's a good summary here. I do think there is so much uncertainty still with how businesses are going to come out of this. It is the biggest probably uncertainty. As I did hear something the other day where 2 out of every 3 business owners says that they have enough cash and resources to make it through 1 year. But after that, they just said it's anybody's guess. So, if there was a short-term modification, if you want to look at that, they get through that and we still don't have a vaccine, you may see, a third of our businesses really in deep trouble. And, we all know that there are survivors and managements that really, have the capital to sustain others that are really kind of week to week. And we are going to see damage. It's just a question of how deep it is and how quickly we can really have a health response to get us out of our economic crisis. That's kind of the way I see it right now.
Yeah, well said, John. Well, a lot of things going on in the world. Sometimes I hate to pick up the paper or look at my paper on the internet. I don't want to date myself and let you know that I'm old enough to know what papers look like. But it's scary. It is a weird time. But even with all the uncertainty that we have facing the industry, we can't stop being strategic. And I think bankers, of course, need to think about the following issues. This is a way, when I say this is a way to just kind of put the issue of strategy and how to face what's going to happen here in the next 12 to 18 months in two simple boxes, two simple buckets. It doesn't mean that they have to be one or the other, but if you kind of take these two ways of thinking and just run your thoughts and your executive team's thoughts through these two kind of buckets, I think it'll at least help crystallize where you lean on what would be the spectrum between survive and thrive. Survive bank is, does my bank take a survive path? Do we hunker down? Do we focus on limited internal growth and we work on cost efficiencies? We improve policy. Do we take this time that's coming up in 2021 to make our management better? In other words, the sentiment should be kind of expressed. I want to be a much better bank by 2022. So 2021 is going to be a year of organizational improvement. And that's, of course, one way to look at it. Of course, that's maybe the extreme, but on the other side, just again, to kind of organize our thoughts, do we thrive? Do we take a thrive path? There will be opportunities both internally and maybe in the form of targeted loan opportunities in selected markets or external opportunities, acquisitions, lift outs that might make 2021 a year of transformation. In other words, saying to yourself, I'm going to be strategically aggressive and I'm going to look for opportunities while other institutions remain more inwardly focused. So as you're thinking about these things, these are things that you can think yourself, take back to your team, and just start having in your skull sessions, in your executive management meetings, kind of bounce these issues around. But while you're doing that, there are some things that we recommend that you do while you're starting to get your strategic legs underneath you. First thing is, okay, we recommend a strategic plan reassessment. I think it's always good to bring that out, reassess where the plan is now, where you are against plan. Of course, it's very difficult from a financial standpoint to match up with the strategic plan, but take a look at it, see where you are. Of course, that would include a capital plan update as well. Stress testing, I think going through a stress testing exercise is a good thing, not only for the loans, but also for the investment portfolio. I think that's a good thing to do as you prepare for your strategic work. Again, ALLL, good to look at that, always good to look at that, and really get into the weeds. Jeff and one of our consultants, one of our top consultants, Pete Fatopoulos, just finished a really deep ALLL review and really brought some new concepts and insights to our client on that. So those are always good things to do. Unfortunately, I think it's time to figure out if you have workout readiness. Back in the day, back in 2010, all the loan officers were in the banks, and many banks were pretty much workout people, and the salespeople were out looking for jobs and trying to figure out what they were going to do. Well, we don't have, as far as I can see, I think there is a dearth of workout people in our banks now, people that really know how to do it, especially at the community bank level. So I would go ahead and just kind of take an inventory and say, okay, who's our workout guys? And we always recommend that at some point in time, a loan officer can handle the deal to a certain period of time or a certain point in time, and then a new face is required. So we always think there should be some workout specialists. Moving forward, take a look, do some multi-year forecasting, reforecasting, and take into consideration some stressed scenarios as John and Jeff talked about earlier. Certainly an operational efficiency analysis in a remote environment. Start taking a look at some of the things that you think you can make money at or improve yourself. We can certainly help you with those types of things. Of course, BCP has been at the top of everyone's mind over the last 3 months. Overall, I think the banks did okay. Some banks were very, very good at BCP. Other banks weren't as good, but go ahead, take a look at that, make sure it's appropriate. Yes, you just went through it, but things are always changing, and make sure that you look forward and take another look at that so that you can capture maybe some events that are on the way. Certainly pandemic documentation review. That's something that I think everyone should take a look at. This one I think is very important. Succession plan and talent assessment. Things are changing. There will be some players that don't want to go through. If we do have another couple tough years, there might be some players in your executive team that don't want to do it, or are at a point where they just, want to do other things in their life. And you need to know that, and you also need to know what kind of talent is below them. And those are some things that you really have to kind of have a handle on. That even ties back to our workout situation. Do we have people that are workout experts and things like that? And then finally, something that we do quite a bit, regulatory exam preparedness. And are you ready for an exam? It's always good to have, take a look and kind of simulate an exam. You don't have to do every part of the bank. You can do it section by section, maybe take the camels and do it that way. But it's always good to kind of take a look at it and see where you are so that you're not caught, blindsided by when the examiners come in and do their work. I thought it would be fun to talk about two situations, a survive situation and a thrive situation. And these are two clients of ours that I think really hit the mark and did it the right way. And I think it would be fun to go through these. Jeff, would you tell us about our $400 million community bank friend?
Thanks, Jim. So yeah, the $400 million community bank was a client that hired us when they received safety and soundness regulatory orders, a consent order. It was your typical flavor consent order, but at that time, relatively new to the process. Management team really was unsure how to proceed with that particular order, and they asked us to come in and assist them. They were a very strong relationship in CRE lender, good business bankers, focused on growth and sales, not so much on the administrative aspect of the side of the business. So they had overly centralized decision making, which resulted in deficient credit risk management policies, procedures, a very high concentration of speculative CRE loans with high loan to values, limited cash flow coming out of those credits. And to top it off, they had poor accounting for their troubled debt and their allowance. The decision was made to augment management. They hired a few people. They used third-party consultants like us to come in. We helped them recognize losses, work out troubled loans. They stopped new business development altogether for a period of time while they were under the order and attempting to get their arms around the problems. They served the existing clients only. They did not seek to increase the new clients at that point in time. They improved the risk management policies and procedures and implementation thereof, and they implemented all of the requirements of a consent order based strategic plan. And again, that's a little bit different. And I know when we get into our next session, we'll talk about some of those differences between consent order strategic plan and a real strategic plan. So over the next 2 years, after they implemented all the provisions in the consent order, it did lead to their improved performance, and ultimately they thrived in a sense by being able to put themselves on the market and sell the bank to a third party at a significant premium.
Yeah, that was a lot of fun to work on, and they worked very hard. They were good people. I'll take this next one. Our $900 million friend is an interesting story. They're deciding they want to grow. They wanted to grow. They could have not grown, but they did want to grow. And they had strengths of, strong capital base, they had a good trust operation, but their weaknesses were low commercial loan levels and growth rates, especially in the area where they were at. It was just kind of interesting how low those were. So in their planning sessions, as we were sitting with them, we were talking about how do we do this? Do we hire, a couple loan officers, or do we go buy a bank? All these things were talked about, and we went through all these things. But what we decided to do was take advantage of, at the time, there was a lot in their marketplace, there was a lot of upheaval as it comes to banks buying each other and, banks merging and things like that. It was just a lot of noise in the marketplace. And they all felt rather, that there could be some very nice opportunities to maybe lift out a team that might be disgruntled and maybe, winds up at a place where they really don't want to. So that became part of the strategic plan. And of course, in that, we kind of identified, what that would look like and the type of credits and things like that. So we put some parameters in that. And sure enough, the market upheaval continued and there were some opportunities. And so this bank then added a C&I team, just a wonderful group that also had really shared almost like hand in glove a culture. And they wound up bringing that team in, and it was fantastic. They increased their C&I balances by 100% and actually had to raise more capital a few years later to support the growth. And so it's just a great example of being nimble and thinking a little bit out of the box, and taking advantage of a situation where maybe other banks are preoccupied with things other than their customers. And that's a good story. That bank went from just over 600 million to, it's about $900 million now. So just a great story. And that was a lot of fun on that assignment as well. So some closing thoughts here before we get to questions. We are in a time of high uncertainty economically, politically. And we have a strong likelihood that bank performance is going to get worse before it gets better, especially when you see some of those past due numbers that look good first quarter and are not going to look real good as we go through. So, but there are actions you can and should take now to prepare your institution. You don't have to be a survive or thrive. Different circumstances call for different approaches, but it is a continuum. It's a way to kind of set your base kind of risk appetite, and then go from there. It's very important when you're thinking about survive and thrive and whatever strategies you have within those, that you need to be nimble and you need to be flexible. Focus on your existing strategic plan, capital needs, your credit, management policies, procedures, exam preparedness, operating efficiency, staffing needs. All these things need to be focused on, and be prepared to take bold action when it's called for. And finally, strategy never stops. Strategy never sleeps. Whatever you want to say, it never stops or sleeps. Plan, assess, adjust. Plan, assess, adjust. So with that, we're out of time, but let's take one question, if you don't mind. Let's see here. Let's see. How about this one? This is a good one. Can you compare bank preparedness pre-Great Recession with our current situation? Are we in better shape or worse shape, and what does that mean? Jeff, you want to take that?
Yeah, sure. I will just take a second here to answer that. We did some deep data dives into the existing bank population as of June 30th, looking back at those banks back in 2009 at the same time as we were going through the downturn. I can tell you, looking at the hard data of the existing bank population that's out there, all banks have better capital today, capital levels, than what they had before. Their efficiency ratios, while John pointed out that they're getting worse, they're actually much better than what they were back then during the downturn. Texas ratios are low. meaning your troubled loans today, at least starting into this recession, are much lower than where they were back then. So that's one of the big differences as you started the process into a recession. I think banks are structured more for that to be able to handle the impact of a recession a lot better.
You know, we're running over, so we've got a number of questions. As we said, I promise we'll email everybody's answers, or at least our opinions on your questions. We'll get that right back to you. I want to thank everybody for joining us today. Look for, as a thank you for coming, look for a gift certificate from Duncan from us. Have a coffee or a donut or something like that, whatever you enjoy at Duncan on us. And we look forward to seeing you on Thursday, September 24th, when we're going to talk about the strategic planning process during a downturn. So in the meantime, if you have any questions or any issues or anything, let me go back a slide and let you see our emails there. Jim Atkins at Artisan Advisors, J. Voss at Artisan Advisors, John Heck, J. Hecht at Artisan Advisors. Feel free to get to us. We also have our website where we have questions. You can always ask us questions anytime you want. So thanks for joining us, and we'll see you in September.